Welcome back, guys, to another roundtable. My name is Adam. With me once again, I have Rusmin.
Hello.
And Victor.
Hi, guys.
Thank you so much for joining us. And today we're going to talk about how to buy stocks during a bear market. All right. So, recently we have the Russia-Ukraine crisis.
Yep.
And I think the S&P 500 dropped about more than 10%. I think it was about 13%.
Yeah,
Yep.
close to.
Goes back from the peak to the bottom. And of course, during COVID in 2020, the markets crashed over 30% as well.
Yep.
So I think there will always be corrections along the way, right? The stock markets will go up and they will come down. And the best time to buy a stock is when prices are cheap,
Yeah.
Correct.
right?
When everyone is scared.
When everyone is scared, all right? So now the question is, if you know that is the best time to buy, how do you actually buy during a bear market? And I think a lot of the stocks have come down. A lot of growth stocks have come down recently as well. So we're going to answer that question and our strategy, our personal strategy that we all use
Yep.
over here on how we actually buy and deploy our capital during a bear market. All right. So first things first, how do you know when to buy? Do you just buy when prices come down?
Yeah, that is one of the strategy. Of course, be greedy when others are fearful, be fearful when others are greedy. Okay, that's what Warren Buffett said, and I think that the best time to buy is basically, like I said, when everyone is scared. But there are also times where you should also be buying stock, even though the market may not be the correction stage. Okay, especially if you come across companies that actually passes your criteria, especially those quality stocks, and then they are trading at a reasonable valuation, right? So, generally for us, I think we look at quality companies. So even if they trade at fair valuation in normal market situation, we will still buy them.
Yep. Right.
Yeah.
So I think in general, if you were to look at the index, let's say the S&P 500, so if a 10% drop, between 10 to 20%, that's around what we call a correction, right? Anything above 20% is what we call a bear market, recession. So the S&P 500 didn't really go to the bear market during the Ukraine, but then it went into the bear market during the COVID-19 pandemic, right? So that's how you can actually define, when it's bear, when it's correction. And of course, correction happens, I think, almost 70% of the time in the past 90 years history of the US market. So it's very common, but do not panic when you see correction, okay? But of course, be more greedy when there's a bear market.
When you say 70% of the time, what do you mean by that?
I mean, the 70% of the time, right, the S&P 500 will fluctuate between 5 to 20% up and down.
Okay.
Yeah.
30% of the time is more than 20%.
Okay.
Yeah.
Okay.
So if you look at the big major drawdowns, I think over the last 50 years, the biggest drawdown in the history is actually your 2009 crash. Okay, the index dropped almost 50%.
Yeah.
Right. So this only happens once every 50 years.
I think it happens for the past 90 years above 50%. It happens 3 times.
Yeah.
Three times.
Yeah.
Okay.
It's very, very rare you see correction like this. Even like the COVID-19, you've seen a correction of close to 30%, right?
Yep.
And that is considered a major crisis, but
Correct.
they never reached close to 50%, mainly because nowadays the government actually intervened quite quickly. Okay, so like 2020, when the whole economy was under lockdown, Fed introduced a lot of liquidity, right? By printing in money, giving money to the citizen and stuff like that, right? So and of course, when situation like that happens, you want to be ready for that. You don't want to be caught in a situation where you don't really have cash to invest.
All right. So I think we're quite clear about these corrections happening. These are the best times to buy. But do you define buying a stock based on prices? Like, just because prices have come down, is that an indication to buy, or do you base it on valuation or something else?
Well, I think at the end it boils down to the fundamentals. So it depends on the stocks that you're looking at. Some people value their stocks based on price to earnings, some based on price to book, some based on price to sales. Right, nowadays with all of growth stock, typically people use price to sale. Right, so depending on which metric that you use, for us, as long as the let's say PE, right, or price to cash flow, that the one that we use more frequent, as long as it's trade at near fair valuation for quality companies, we may consider. So, but you still boils down to the valuation, right? Not based on the share price is drop and then you just quickly go and buy.
Yep.
Yeah.
I think that's the main thing that I think we should point out is that just because prices have come down doesn't mean it's actually time to buy.
Yes, yeah.
Because it could still, prices could come down and it's still expensive.
Yeah.
Because it was more expensive before that.
Yes, correct.
Yes.
Because
So-
some companies can be traded above their average,
Yeah.
average like let's say P valuation,
Yeah.
right? They trade it above like 1 standard or 2 standard deviation, even though they have fallen, but they are still above 1 standard deviation, so they are still expensive. So at the end of the day, is really you have to be very consistent with your valuation. That's the first thing. Second is you must know what's the percentage standard deviation from the mean, and you just buy according to that, right?
Okay, so basically you use a strategy of mean reversion. Basically,
correct.
the stock kind of trades at this average.
Yep.
Yeah.
And if it's more than that, it's technically overvalued.
Yep.
If below that, it's undervalued.
Yeah.
Right?
So I think if you look at the first half of 2021, there were a lot of high growth stocks that were trading at a very crazy valuation.
Yeah.
Some are like hundreds times price to sales. Even after they crashed by 50%, they're still trading at a price to sales of about 50 times, right?
Yeah,
still
very
considered
expensive.
expensive, right?
Yeah.
So you got to be careful, and you just want to look at the historical
I think that's one of the mistakes that many beginners make, is that they see a stock price crash by 50% and it goes cheap, but it's just based on share prices. And you have to actually go one step further and actually look at the valuation and its fundamentals before you actually jump in. All right, so I think we've established that. Let's move on to the next step, which is basically, so right now you've found a stock, you've gone through its fundamentals, you like it, you think it's a great company, and it's cheap in terms of valuation, not just price, but valuation. So what is your strategy when a stock hits the value that you're actually looking at?
Yeah, I think most people, right, I think nowadays the investors are quite smart, right? So when the crisis comes, they know that, oh, this is opportunity. So a lot of especially new investor, they come rushing in, to buy into the market, right? Some of them may have used up all their bullets, when they see the market have fallen, then they use their bullets. But at the end of the day, you must really ask yourself, do the market just fall, the share price fall, and they straight away recover on a V shape? No, it don't happen, right? The markets fall, consistently throughout the months, right? But then of course, the previous COVID-19 crisis was an exception where within 1 month it's like a V-shaped recovery. But most crises, if you look in the past, they fall from 6 months to 2 years, taking their time going down until they hit the bottom, right? So we have to all understand that your first purchase price may not be the best price, right? Eventually, the market is like a falling knife. You just keep going down. So the best way to do it is to split it into trenches strategy, right? Instead of like, let's say you got example 100,000 to buy into a stock, right? You don't buy with the 100,000. You split it to three trenches, right? And when every time it hits a certain criteria, let's say fair value, you buy one trench. One standard deviation, you buy a second trench, and the third second standard deviation, you buy your third trench, and that's it, right? So that in that way, right, you can cover all grounds already, right? So
maybe to put that into context, I think Chinese tech is the best example of what Victor is trying to say, right? I think we saw a lot of Chinese tech got sell down, I think starting or mid of 2021, right? That was where after the Ant Group cracked down, and then there were a whole wave of Chinese tech regulation, and that caused the whole sector to be depressed. Okay, at the time I still remember was in July or August, we were looking at Chinese tech, and the sector already crashed by the whole index, Hang Tech ETF, the index itself crashed about, I think, 40%. I still remember, right? So that was the time we started to go in, and basically it passes all our valuation criteria. It was near at the historical low valuation, 1 standard deviation for some stocks, right? So we started to buy. And then, of course, if you only have the strategy where, it crashed 40%, you just go in and buy. That's it. But then after that, towards the end of the year, in the first half of 2022, we saw the whole market crash another half from where we started to buy at the time. So the whole index, you measure from peak to trough, I think you're looking at about 60% down.
Okay.
Right. So from a 40% correction go down to 60%, it means 50% for those people who bought. Right. So when that situation happened, we want to have a cash to deploy, right? So so the trench strategy actually comes in very handy, right? So you can position in such a way that, let's say you intend to own a stock, let's say Tencent or Baba, for example, right? You look at, let's say, $10,000, for example, Alibaba, because Tencent is too big, right? So Alibaba, for example, you break down into 3 tranches. All right. So the first tranche maybe could be 4,000. All right. And the second tranche could be another 3,000. And the third tranche could be 3,000. Okay. Depends on how comfortable you are, right, with the stock or the opportunity that you feel that the attractiveness of the stock at the point of time, right?
Okay.
So if you want to be heavier, 5, 3, 2, or some people like 3, then 4 because they want to deploy the maximum cash at the best valuation.
So basically, what you're saying is don't fire your bullets all at one go.
Yep.
Yeah.
I mean, yes, you're looking at the stock. You've been monitoring it for some time. Great fundamentals, and it's cheap. And then you don't. But you're saying don't fire your bullets at one go.
Yeah.
Shoot one shot.
Yep.
Okay.
Yeah.
Yeah.
Well, yeah. Some people, you have no choice if your capital is small.
Okay.
Then you of course you just only have one single shot to begin with, right?
Then you have to really wait for the the so-called the best value that you want to buy, right? Why we use this strategy is because you really literally remove the emotion of the game, right? Because I've seen investors, right, who let's say they buy the stocks at $100, right? The stocks drop 5%, they just keep buying, right? Without understanding the valuation, because they see that, I lose 5%, lose 10%, they just keep increasing the stake. But after sometimes you realize that it becomes a very big portion of your whole
then
portfolio.
you have exposure to that.
So in the case of Baba, let's say 200 started buying, and then 180 started buying, 160 buy everything, right?
Then you don't have any.
Then after you drop to 80 at one point, right? 90s, people panic, and at that stage where even you don't have cash, people you might go into desperation mode, depression, right? So, and I mean, I've seen that happening, right? Every time when the sector is under the major sell down, there was so many bad news, people just panic. Right?
And you'll question whether did I do the right investment at the point of time, right?
Yeah. Okay.
And you don't have cash to catch that $100 or $90 a share,
All right.
So that is the time where you feel really panic.
All right. So assuming you have enough capital to spread your, you have enough trenches to go. Basically, you're saying don't fire your bullets all at one go. Right? Because it could go lower.
Yes.
Correct.
Of course, the question is, after you fire your first tranche, so what is the so-called trigger point for your second tranche, right?
Okay.
So that percentage drop, of course, it has to based on your cost price, right? So let's say you bought at $1. Then it depends on how volatile the stock is going to be, right? If it's very volatile stocks, I think you might want to put a 20 to 30% from your first purchase price. So let's say $1 you bought, maybe in the next one it's going to be, let's say you put it 20%, you can buy it at next tranche is going to be 80 cents. Right?
Wouldn't you base it on valuation instead of prices?
Yeah, because if your first tranche is already past the valuation stage, let's say on one standard deviation, your second tranche, if you base on 20% down, it's likely going to hit your second.
Okay. So you still go back to the valuations, right?
Yeah, you still go back to the valuation.
Right. Okay.
Right. By then it should be a lot cheaper actually, right? So and then of course your third tranche will be 20% from your 80 cent, which is going to be your 64 cent, right? So that will in total, I mean, you are positioning yourself for this particular stock to be down about close to 36% crash, right? So if you want 50% kind of crash, of course you can put 30%, right, instead of like 20%, right? So again, it depends. Some stocks are just not as volatile, especially your FANG, excluding Facebook, but those like Microsoft, which is a lot very stable, right? Even during the Ukraine war, they don't really move that much. So that is a strategy where it may suit them better. Right. So again, some volatile stock you can put higher percentage, less volatile stock you can put lower percentage.
All right. So actually, it seems quite you have to accommodate for the stocks itself. It's not just like you have a blanket strategy, but then you got to be familiar with the stocks as well, how they move, and what the volatility is like, and then basically your strategy of deploying the trenches would have to fit that stock as well.
So again, ideally, of course, one single strategy is the best when you know that's the lowest. When you know that's the bottom, which is impossible, right? So that will be like the moment you know that's the lowest, one tranche you hit everything and then it starts to rebound and then you make the most money.
No one can
predict.
No one can do that.
And the reason why we have this strategy, of course, is to make sure that our psychologically we are more stable because we know we have cash to take the opportunity.
All right. So I think I just want to summarize everything so far. Is basically to keep it as in a nutshell, you look at the valuation, it reaches the valuation, you buy a little bit. If it goes down some more, it reaches the next stage in your valuation, maybe a second standard deviation away from the mean, you deploy another tranche and then so on. So basically the idea is not to shoot everything in one shot. All right. So the question now is that someone could just go in the first tranche and then the stock immediately jumps up and he goes like, hey, I wanted to buy more.
You should have bought more.
I should have bought everything then. So what do you say to people like that?
Well, I think at least, and I think one rule in investing is that never lose money, right? So as long as you don't lose money in stock, I think even if you have one exposure, if that stock is really solid stock, by the time it doubles up in a year or 3 years down the road, I think, let's say if you deploy a 3% of that stock, that could become 6% of your cost, right, in the future. So I think you should not be worried that much if you didn't deploy fully. Even for in the situation, let's say reverse, right? After that you bought and then you crash further, sometimes you start to question whether you should do your second tranche, third tranche, because your fears start to kick in. It happens when there are so many bad news, right?
That's why you got to be so familiar with your business, because if you don't know what's happening, it can be really scary.
I think the person who said that is actually more of a hindsight bias. Like what Rusmi said, if it goes down, you won't say this way, right? Am I right?
Yes,
So I think if you were to say this way, right, it means that your investing got no system, right? Because you buying and you go up, right? That maybe is a luck or something. But if you have the right system, you can keep duplicating the system, right? So investing is about system. It's not about I buy now and it go up, I can't buy, I should buy it more. And that's not system to me.
So it's like very emotional in a sense. You just want to strip away the emotion.
Correct.
Invest according to the rules. I mean, traders do the same thing as well.
Correct. I mean, if you want to be successful, you really have to invest according to a system, but not invest according to your emotion. Right?
All right. So no one can actually predict the bottom anyway and go like all in at that point and then look at everything goes up perfectly. Because if you can do that, then...
I mean, someone can do that maybe one time, but that's luck. But you can't do that consistently at the bottom. Right? It's very hard. If somebody tell you I'm consistently at the bottom, that guy is a fraud, man.
Okay. So, so basically we have this strategy of like deploying in stages. All right. I think if you have enough capital, that is something you can consider for yourself. What about technical analysis? I mean, some people look at technical analysis. How would you combine technical analysis with? Because some people could say, look, the prices are coming down. Why would I want to buy when prices are still falling? All right. Shouldn't I wait for prices to rebound according to my technical analysis? And then I jump in?
I think it does help, but you must know what you are doing. You must know what's the technical indicator to look at. I have friends who do that. They did it pretty well. But of course, you must do technical analysis on a fundamental strong company. You don't do it on a speculative company, right? At least you know at the end of the day, there's something to back the share price, a business behind, fundamentally strong. Even if you do technical analysis, right, you also will not catch the bottom because they have to wait for time, right? They have to wait for the reversal signal, wait for the moving average to cross and all this, right? By the time you buy, it's slightly a higher price, but it still may be the lower price than most fundamentals, right?
Because if I were to use this strategy during the COVID sell down, I think I'll probably miss out the bulk of it because that it happens. The selling down was happening so quickly at that point of time. I remember it was like within a week, everything just go to the lowest and then it all rebounded.
Right. So the rebound was too fast, you're saying?
It was way too fast. So if you were to stick to strategy, you're going to miss out tons of opportunities there.
So I think the best price comes from maximum pessimism. Right, but by the time you wait for the moving average to come back up and all this, right? Usually there's slight optimism in the.
But that's what they are saying is that I don't need to buy at the bottom, but I rather buy when it's above the bottom, but I know it's going up rather than buying on the way down, right?
So I think there's no right, no wrong. Is to have to be very consistent with your strategy. You don't switch around your strategy, but you be consistent, right?
Yeah, as long as you know what you are doing, you don't mind not getting the lowest. That's fine. Yeah, because really sometimes catching the falling knife can be really scary. You buy those stock that really cliff down and then you purchase it. The next moment you cliff down another 50% from a purchase price. When you gone through that phase, if you are scared, then moving average comes in very handy for you.
If you are those like what Rusmi has said, I think that will be best suit for you.
Yeah, because we have experienced it real hand, right? Trying to catch falling line and then you just drop another 50%.
But for us, I think we are quite used to it. So
I mean, and we have a very long-term perspective as well. Because we're going to hold a business for a long time.
Yeah, and we have a diversified portfolio. We have a proper system where we actually use it to buy. Yeah. So we won't panic if let's say one stock just crashed by 50%.
Yeah, I think that plays a role as well, because we do have an overall strategy. This is just one part of investing that we're discussing today, which is buying during a bear market and our strategy for that. But there are a lot of other things that we do into managing our portfolio to mitigate our risk and all that. I think if someone went all in on the stock and it really happened that way, it would be really scary, right?
You're going to have heart attack.
You're going to have a heart attack. Yeah. But if it's just a portion of your portfolio, it's a lot better.
Yeah. So sometimes, of course, that three tranche strategy applies in that instance, but there are cases where you may bought one tranche in this market, let's say in 2022, then 2023 there's another crash. Then again, you go back to your fundamentals, right? And this is where you can deploy your second tranche if it hits your valuation again. Yeah. Right. So sometimes you can buy up. Not necessarily you have to buy down all the time. Right?
Yeah. So the company can be 1 year later still at 1 standard deviation, or maybe lower 2 standard deviation, but the price is higher than the previous crash.
Value of the business is
the intrinsic value has gone up.
So at the end of the day, focus on the valuation, not the price.
All right, so I think we want to summarize this as, I think there's a lot of things that we discussed today. We basically wanted to share our strategy of how we deployed our capital, across a series of tranches. The moment a stock becomes attractive to us, based on valuation, not just price. And this is how we do it. There are things that we tweak along the way as well.
Yes.
And then we have to basically be familiar with our business that we're investing in.
I think what we share is just in general, but along the way you have to tweak, like what you say.
Yeah. I think that the best experience is still, of course, going through it yourself.
Correct.
Deploying the money, because this is all very theoretical. Very nice to hear, but being in the trenches is actually very different as well.
You must have your emotion in the game, then you will know what is really you are doing.
So I hope this really helped you out, because I think recently some of the growth stocks have come down a lot, China Tech as well. And of course, there'll always be corrections along the way, and this will always apply to that situation when you meet it, when it comes, and how you're going to react to it. All right, so I hope this was a very helpful roundtable for you, because I think this will always happen, and these are tips that we use ourselves. All right, so once again, my name is Adam, that is Rusmin.
Thank you.
That is Victor.
Thank
you so much for joining us. If you like this roundtable, please hit the like button, tell us we're doing a great job, subscribe to our channel, many more roundtables coming up again. And of course, any questions about this, if you want any clarifications about how we do the strategy, feel free to put them in the comment section and we'll answer your questions as well. So once again, thank you for joining us, and we'll see you around again.